All right, we have more changes unfolding in the U.S. economy and apparently over at the Federal Reserve. Changes that have a sudden and remarkably consistent view beginning to pour out of Wall Street this week, right on schedule. Virtually all major investment banks reversed course, no longer forecasting higher for longer. In fact, higher for longer is apparently gone, rolled up and tossed out as somebody over at the Fed decided to leak this out. The info making its way over to Nick T at the Wall Street Journal, Jerome Powell's personal stenographer. But what's being reported is only half the story. The soft landing, no landing BS should be taken with a grain of salt, as two investment banks sent out client notes this week as well, breaking from the fold, but these notes were written and stamped by a small number of their analysts instead of the banks themselves, warning their clients about why the Fed may really be about to cut the overnight rate, and it's got nothing to do with a soft landing. Well, we have the notes, we have the statements, and we're going to review them together in the second half of the video. One of them in particular you're really going to want to see, but before we get started, press the like button and consider subscribing. It helps me out, and I appreciate your support. So positioning, folks, investor positioning, more specifically, big money positioning changed this week. Most analyst coverage that you'll read has to do with technicals or fundamentals, but the best way to understand what's happening short term, at least, is to look at flows, inflows and outflows. Follow the money. And this week, the market fell for the no landing narrative, hook, line, and sinker, seeing the first outflow from U.S. Treasury funds since February of this year and large inflows back into equities. Take a look at last week. We saw a $23.5 billion inflow to stocks, $20.5 billion to cash, $2.6 billion to bonds, and a $400 million outflow from gold. But according to B of A's chief financial strategist, it's overdone, overcooked. He says he's fading it. And remember, Hartnett's the guy who called this rally correctly, the only analyst who successfully got it right. Morgan Stanley's Mike Wilson told his clients to forget about a year-end rally, which turned out to be completely wrong. I've said this numerous times, Hartnett, he's right much more than he's wrong, which is why I personally look forward to his Friday notes. And what he and two other senior analysts wrote is important, warning their clients about something that you won't hear in financial media. We're going to look at it in a minute. But first, just some context, all right? A few weeks ago, we began to see interest rates rise closer to where they should be, where historical bond spreads tell you that they should be, specifically on the long end. We saw the 30-year, the 20-year as well, both cross 5%, and even the 10-year hit that magical 5% number. Well, we all know what happened since. Bond markets rallied, sending yields crashing, but was it all overdone? Will we see interest rates bounce higher? Well, not according to broad Wall Street consensus. Take a look at this. B of A's fund manager survey was just released for November, and it paints a completely different picture than it did last month, really than it has for the entire year. Sent out to 168 hedge fund managers to get their insight and their feedback on the market, and for our purposes, what they see happening with the Fed and with interest rates. I summarized the results of the survey on Twitter or on X. If you're not already following me there, I recommend that you do. I post a lot there that I can't always put in a video. So take a look at the results. Out of the 168 fund managers, 74% predict a soft or no landing. 76% say Fed is done hiking. 80% expecting lower short-term rates. 61% expecting lower bond yields next year. Only 6% say we'll see CPI move higher in 2024. Only 6% see higher inflation next year. Also, if you want to see the actual details of the report, the full report, you can go to my website, rjtalks.com. You can get access to our research database there to get full access to it. So what does this mean? Well, there's clearly been a major shift in sentiment, but according to one of these investment banks, the Fed has numbers that haven't made their way to the public data set yet. I'll show you what they mean or what they said in a minute, but it's not just these fund managers who are suddenly repositioning for rate cuts. Regular investors are as well. Take a look at this. Interest rate futures, betting odds for rate cuts spiked this week. The Fed Watch tool now puts the chances of a March 2024 rate cut at 28%. That's just next quarter, and 50% for May. It's crazy, but At the same time, it's pretty awesome if you like to trade on interest rates. Now, 2 months ago, the market unambiguously agreed that there was going to be 2 more hikes this year. It's just amazing how this happens time after time. It's a game, folks. They leak this info out to shift sentiment, make sure that the rally gets an even larger boost than it already had, but it's fake. It's not real. Christmas came early this year, the Christmas rally, as nothing's changed from 2 weeks ago. The CPI, PPI numbers were a joke last week. Look, it's important to remember how often the general consensus is right. Never, hardly ever. You can see how wrong the market almost always is, like you see in this chart. And right now, general consensus says that the Fed's achieving their soft landing or even a no landing, and will begin cutting rates early next year to avoid an unnecessary recession. That's what you'll hear in financial media all day long. But what you may not hear or even be aware of is what these investment banks and their analysts are warning clients about behind the scenes. Two very different things. For example, both Morgan Stanley and UBS both predicting sharp rate cuts in 2024, but not because the Fed achieved their soft landing and trying to prevent recession. Instead, they believe the Fed will be forced to cut rates, just like what's happened every other time they've tightened like this. Realize, never, not once, has the Fed managed to pull off a soft landing and prevent a recession after tightening to this extent. But of course, this time's going to be different, right? So what are these two saying? They're saying that by Q2 of next year, the U.S. economy falls into a hard landing, a full-blown recession, and in which the Fed has no choice but to cut hard and fast. UBS says this: they're going to be forced to cut as much as 275 basis points next year to stem the bleeding. They write this: the U.S. economy will slip into recession next year, and that it'll lead to the Federal Reserve bringing in steep interest rate cuts, saying that the Fed now knows that falling inflation is due to an economic slump yet to make its way into the public data set, but that they're already aware of it, and the downturn will be so bad they're planning for an eye-popping 275 basis points of rate cuts. That's almost 4 times the 75 basis point reduction that the market is currently expecting. Now, that was from the European bank UBS. Morgan Stanley, though, as well, sees massive cuts taking place next year, and for the same reason, recession. They're forecasting that the Fed funds rate drops from 5.5%, where it is today, to 2.375% by the end of next year, by the end of 2024. Now, whether you buy into this or not, one thing's for sure: Wall Street is on the rate cut bandwagon again. 2 weeks ago, it was higher for longer. Now they've flipped just like that, all at the same time, spurred on by the new CPI print and the recent PPI numbers released this week confirming prices are coming down. You know, we're now running a 3.2% annual inflation rate. That's like overall inflation. That's headline inflation. And why all like the hoopla around this? Because it came in below Wall Street estimates. But if you really look at prices, it's nothing to get excited about. In fact, it was pretty bad. A huge part of the drop came from gas prices crashing. And if you strip out energy and look at core CPI, which excludes food and energy, still at 4%, double where the Fed says that they want it. But most notable of all is rents. We've been hearing so much about rents this past year that we'll see rent CPI fall, that rents are falling. But in reality, they've barely fallen. And last month, rents jumped. You could see this easier broken out on our maps. This is from the Zillow Observed Rent Index, which is calculated by asking rents. So it's not exactly what you see reflected in the CPI numbers, but still, look at this. Virtually the entire country is green, positive. Rent prices year over year continue moving higher. Only in like a couple counties do we see rents dropping. Austin, Texas is one of those markets, now down 2.7% from October of last year. So the median asking rent has fallen $50, just $50 since last year in Austin. But look at everywhere else. Look at San Luis Obispo, for instance, up 7.3% from last year, which is actually really close to what the CPI data showed. If you looked at the numbers from last week or from earlier in this week, rent CPI increased by 7.2%. So rents aren't falling much, folks, not yet at least. Point is, like always, people want the Fed to be done so badly that they just fall for this every single time. This narrative that the Fed's going to or that the Fed's getting ready to cut rates next quarter because they've achieved their soft landing. It's BS, folks. I don't personally buy it. Only way I see that happening is if we fall into recession. Otherwise, a long sustained pause followed by a slow, steady descent in the night rate, my opinion's much more likely. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.